Thus far, no American president has ever been removed from office due to an impeachment and conviction. A president becomes impeached if the House votes on one or more articles of impeachment, and one of those articles receives a majority vote. Then the Senate holds a trial overseen by the Chief Justice of the Supreme Court, with lawmakers from the House serving as prosecutors. The president has defense lawyers, and the Senate is the jury. If two-thirds of the Senate find the impeached president guilty, the president could be removed from office. So, with politics aside, the question for investors is, if the president is impeached, what is the impact on the stock market? Well, let's take a look. Well, it's now official. Speaker of the House Nancy Pelosi announced that the House of Representatives will open a formal impeachment inquiry into President Donald Trump. Leaving the political punditry to the wacky media, what we care about is the impact that an impeachment may have on the stock market. Democrats have been extreme critics of Trump's policies and behavior as president, but all during this, the stock market has performed relatively well since Trump took office. The S&P 500 index is up about 39% since Trump was elected in November of 2016. To understand the question whether impeachment impacts the stock market, we need to look at other examples. However, we don't have a lot of examples to go by. We do have President Andrew Johnson shown here, who was the first president to be impeached, but he was not convicted. And while there may be market data from back then, I don't have any of it. So we move on to 1974 when impeachment proceedings began against Richard Nixon. But that was a short circuit because the impeachment process ended when Nixon resigned as president. And then there was Bill Clinton, who was impeached in 1998 but acquitted in 1999. So these are the only examples we have to compare. Starting with Nixon from February 6, 1974, when the impeachment process against Nixon formally began, through August 9th of 1974, when Nixon resigned, the S&P 500 dropped 13%. So clearly, that tells us that impeachment is probably not a good thing for the stock market. As Watergate unfolded in the 1973 to 74 timeframe, stocks plunged in one of the worst bear markets following World War II. Stocks bottomed less than 2 months after Nixon resigned. But beginning in April of 1973, top Nixon aides H.R. Haldeman and John Ehrlichman were forced to step down. Stocks were volatile, but still held up while former White House counsel John Dean began testifying before the Senate Watergate Committee in June of 1973 and during the Saturday Night Massacre of October 20th that same year. But stocks had started falling that November and continued to drop through the president's August 1974 resignation. Some of that was certainly impeachment related, but in October of 1973, OPEC had announced an embargo on oil shipments to countries that helped Israel during that year's Yom Kippur War. That created shortages and long lines at U.S. gas stations, and oil prices nearly quadrupled in only a few months. After rising 3.3% in 1972, the CPI popped 6.2% in 1973 and then rocketed 11.1% in 1974. And that was the beginning of the great inflation of the 1970s, and it ended the so-called golden age of the U.S. economy. The bear market that ran from January of 1973 through October of 1974 took the S&P 500 down by 48%. Looking at Bill Clinton, you can see from this chart here that stocks rose into July 1998 as legal proceedings about the Lewinsky affair heated up and the president later testified before a grand jury. But stocks continued to fall, hitting a classic double bottom between late August and early October. Then the market rallied and didn't look back, even as the House impeached the president. In February 1999, the Senate voted not to remove Clinton from office. Economically, the important events during the time was that summer and early fall when the Asian currency crisis morphed into a major crisis for the Russian economy. That was followed by the collapse of hedge fund long-term capital management and the bailout led by the Federal Reserve Bank of New York. Soon after that, the internet mania was launched. That raged until the Nasdaq topped 5,000 and the bull market ended in March of 2000. In fact, the S&P 500 climbed more than 40% 6 months after impeachment inquiries started on President Clinton. So, history is mixed whether impeachment has any significant influence on the stock market. It appears that economic conditions are more important. But back to Trump. Even if House Democrats produce stone cold proof that President Trump bullied Ukraine's president to dig up dirt on former Vice President Joe Biden and his son, and vote to impeach Trump, at this point, it's hard to imagine the Senate coming up with 67 votes necessary to remove Trump from office. The Senate couldn't even do that in 1868 with President Andrew Johnson, who tried to undermine Reconstruction and who tried to protect former slave owners after the Civil War. History suggests that it will be a challenge for the Democrats to complete the process of impeachment and conviction before Election Day 2020. The impeachment proceedings will likely further deteriorate the U.S. domestic political climate. More importantly, it will add to the range of factors that are creating the uncertainty for the economic outlook. Further, it will likely reduce the chance of meaningful fiscal policy legislation. No surprise there. Therefore, another Fed rate cut before the end of the year is now more likely as an insurance policy. It also makes the forecast of a recession in 2020 and the Fed cutting all the way back to zero before the end of 2020 all that more likely. And with all of the charades and distractions, we still have China and Iran to deal with. Overall, other than short-term volatility, I don't believe the impeachment proceedings themselves will significantly impact the market. However, the political machinations will add more complications to the story. The bigger story will be whether the Fed makes another rate cut, the trade talks, and a potential recession in the near future. And for today, that's ChewDog Charts. Thank you.